Well, it's been a week of deals and potential deals from African Bank in talks to sell Ellerines, perhaps Old Mutual buying African Bank, so the rumour mill goes. SABMiller selling its stake in Tsogo and Anglo American possibly, finally, maybe, finally offloading Tarmac. Since 2006, Africa has seen mergers and acquisitions worth about $276 billion taking place. This is Tonight. I'm Bruce Whitfield, and tonight we'll look at how you might make some money from following these deals. Joining me is Brandon Irsigler, who is Director at Norton Fulbright, and Vestact's Sasha Naryshkine. Sasha, how do you make money out of deals?
I said to your producer when he asked me, and I said, it's simple, you make sure that you're an investment banker.
But are they the only guys who make money out of corporate deals like this?
Well, I mean, no two deals are the same, right? You know, I mean, there's a certain cycle where one can tell a little bit more exuberance. And in fact, at a global level, we're at a best sort of levels for 7 odd years. But there's a slight difference with these deals being done on a global basis. A lot of them are actually being funded through cash. So these are American companies with cash outside of the US who are looking to, you know, buy businesses, specifically get and move their corporate headquarters to places like Ireland.
Yeah, places like that. It feels like we've seen this movie before. But when one looks at corporate deals, and one would have thought post-2008, the meltdown, the financial crisis, we would have seen lots more deals post-2008. That didn't happen. I remember Brian Joffe getting terribly frustrated because he was expecting to pick up lots of businesses for a song in 2008, 2009. It simply didn't happen. Why is it happening at what might be, and you're going to shoot me for this one, a peak in the cycle?
I don't think it's a peak. Actually, I think it's the start of M&A activity because nobody seems to be overpaying. You know, I read somewhere that the average EBITDA multiple is like less than 14, which doesn't indicate that you're anywhere near the top of any cycle as it plays itself out. But I think each one is different. I mean, back then it was private equity, leveraged buyouts, borrowing lots of cheap money. Now it's just utilizing your existing resources. So when you start to see more borrowing and some of the deals not making sense, then I think that's the point where you say, okay, looking a bit toppy in the cycle here.
Brandon's nodding like his head's about to fall off. You concur then, do you, Brandon?
I do concur. What I followed out of it, I absolutely agree. We're seeing much the same.
It's all well and good to have all of these great deals happening. What is the lead time typically on deals? We look at the Tarmac deal. Anglos have been desperate to get rid of this thing since before you worked there, for example. I mean, it's been a long time that they've been wanting to get rid of Tarmac. We know that African Bank has been wanting to get rid of Ellerines since about 3 days after it bought it. These deals don't happen overnight, do they?
No, they don't. Typically, as lawyers, we get involved when there's a term sheet, when there are parties at the table, or when a bid process has been initiated. And you can generally tell by the level of frustration in the room how long the deal has been festering or been promoted within the business. I think Anglo was correct in not doing a deal at any cost with Tarmac. Tarmac was always profitable as far as I can recall, and it was just not core to its business. So
as, for example, Tsogo with SABMiller, not core to its business. However, SABMiller has held on to the Tsogo stake for how long?
Gee, I think since they injected it in there, and plus those two have done a deal themselves. So these are legacy assets from a time when SABMiller was just SAB and couldn't buy anything except regional assets, and more specifically South African assets. So that's how old they are. Okay, so this is in a time gone past where they only held these assets because they couldn't grow outside of South Africa.
So is it possible then, Sasha, in your worldly experience, to make money as an investor out of deals like this, anticipating the deals, forecasting the deals, buying shares that are going to be involved in corporate action? Because certainly the financial press worldwide focuses on doing potential deals all the time, as if it is a market-moving activity.
Yeah, I'm trying to think, but I think out of all the investments we've ever held, I think Massmart's probably the only one. I think sometimes you have to hold a kind of a smaller to mid-cap, although, you know, I mean, Pfizer bidding for AstraZeneca, that was, what, nearly $120 billion. So they can happen at a mega basis, but normally I think in a listed environment you would see maybe a merger, not too much price movement away from what the market would have anticipated, because that's the key part. what the market anticipates.
But sometimes you've got to look out for clues. And recently I interviewed Leon Kokenis. I went to the call center at African Bank, interviewed Leon Kokenis. We spoke about Ellerines, and he was sort of saying, you know, be patient, the deal is coming. And then I posed the question to him about whether or not African Bank itself was up for grabs. Have a listen to what he says, how he says it, and what how he says it tells you in just a moment. Is anyone knocking on the door, Leon?
I can't say that.
Okay. It implies that there might be interest.
I can't say anything in that regard. All I can say is that this is a great business.
Okay, he said a bit more than that. We went to and fro for quite a while, in which he danced and tap danced and was terribly cautious. He didn't say no. And I said to him at that point, well, surely then, Mr. Kokenis, it means that there is a deal looming. This Sunday, in the newspapers, Old Mutual seems to be circling African Bank. Is that an indicator for you, Brandon, when you're looking at potential deals being happening, when chief executives have never donned a pair of dancing shoes in their lives start tap dancing like that?
They generally don't tap dance for their lawyers. We tap dance for them.
You get paid enough, you'll be fine.
What I do think is interesting is when a management team that is not known for being acquisitive, that is known for sweating its assets, is known for putting its nose to the grindstone and getting on with its sector, suddenly starts talking in ways that it hasn't spoken before. And you do get different types of management teams. We'll deal with them all the time as lawyers. You get the acquisitive, non-organic growth types, and then you do get people who are very comfortable with sticking with their knitting and that sort of thing. And when you generally feel from the body language whether people are comfortable with doing a deal or it's very much outside of their bailiwick, if you want to put it like that. So yeah, we tend to experience it on that level.
Is it worth buying African Bank, which on Monday, following the news that it had found a buyer for Ellerines, spiked up 17%, then plummeted 7% on Tuesday, and then was looking a little bit sluggish on Wednesday? Is it worth buying an African Bank in the hope that once the Ellerines deal is done, African Bank itself comes up for grabs?
Yeah, you're presuming that they get a good price for Ellerines.
And
that's the presumption that you're making. I mean, they might well want to just get rid of it.
Do what OK Bazaars did and was sold for R1, wasn't it?
Well, you wouldn't want to think it goes for a song, but you never know. So you don't know what the price is. Equally, you don't know who the suitor is and what their intentions are too. I remember speaking.
Suggests Steinhoff.
Well, then it raises all sorts of competitions issues. So I don't know, Bruce. I mean, I remember speaking to someone at Abil 10 years ago in the last cycle, to their investor relations person, and I said, how come no one has ever bought African Bank? And I was very young, naive, asking, and she said, probably when it was too cheap, it was too risky.
And that's the line that Leon Kokenis still uses to this day. When things are going well, it's too expensive, and when it's too cheap, it's too risky to buy. But it looks like a bank that can't continue to survive on its own. It looks like it's going to need a big brother of some kind. Is it a deal that you anticipate?
I don't think so. I think as long as they're able to raise money at a cheap-ish rate, and those rates have risen, and I think this management team will sail through the storm, and it's whether the institutional shareholders in the aftermath of that will look for a deal to unlock a little bit of their purchasing at this lower price.
Are there lots of deals pending, as far as you can tell? You must watch your competitors watch you. Are we at the beginning of a cycle, as Sasha suggested as we started this chat?
From a gut feel, yes.
And how good is your gut?
Oh, it's large.
How good is it?
No, I think not talking of my gut specifically, but I think of from the team that I work with, our sense is very much that this is the beginning of a cycle, that people have been holding on to cash for political reasons. They haven't been sure where the economy is going to go or what path is going to be followed by government, and suddenly they feel that cash is burning a hole in their pocket. They're feeling the need to excel, make a name for themselves, and I think they're seeing some assets certainly are coming onto the market, and those would be assets that they'd want.
I mean, we saw it took years for the Barclays Africa deal to come to life, for example. It takes an awfully long time. Standard Bank is undoing a whole lot of the purchases it made internationally, as far afield as Russia, in London, and in Argentina as well. Not all deals, Sasha, are made of money.
Oh, Times Warner AOL. Sorry, Bruce.
Yes, exactly. Just remind Time Warner AOL, I mean, was probably the biggest disaster in terms of a media deal in centuries.
But it was a merger of two overpriced equals. So, at the time it made sense.
Fair, one was far more overpriced than the other.
But they were both overpriced, you know. They were both overpriced. And you could be sitting all of 15 years odd later in, one or other of those investments saying to yourself, gee, I wish they'd never done it.
Yes. So the basic rules of investment apply. Don't be stupid. And don't go and buy companies simply because you think there may be corporate action.
Exactly.
Traders may speculate in the morning and get out in the afternoon. But if you're a proper investor, a grown-up, just like yourself,
sure. Thanks,
then you're doing deals on market fundamentals, on company fundamentals, not on whether or not something that may or may not happen, might or might not happen.
Exactly, and there are some serial deal makers in a South African sense that seem to have got it spot on. The aforementioned Steinhoff and Marcus Jooste and Stephen Saad from Aspen. They're good deal makers who seem to get it right almost every time.
But even good deal makers get themselves into trouble. Our next episode of Tonight with Bruce Whitfield, we're looking at the Aspen phone call that has gone awry and is really dragging Aspen's name through the mud. They're not always perfect, are they?
Well, misinterpretations, The problem was there was actually no transcript of that. So I listened to it for the entire half an hour, and there is no PVR. You can't rewind. You've got to phone back in. And who has an extra half an hour to waste over and over again?
But the point is, not all companies are perfect. Just because they've been good deal makers doesn't make them great deal makers into the future. Up until African Bank did the Ellerines deal, it was a great business, and it had been very successful. But things went pear-shaped after that.
Well, is that a question, or is that a rhetorical question?
That is a question. It's a comment, and seeking further enlightenment from yourself.
Ellerines had been an old-tired business, and maybe they were looking to exit, the Ellerine brothers, at that stage. And it probably did make sense from a distribution network. Abil were able to get many more points of sales, and that's what they were looking for in order to expand their business.
The debtors book.
Yeah, exactly.
And the debtors book, it seemed terribly attractive at the time. It's been a bit of a mess. A lot of deals go awry. Only a fraction probably really are worth doing, ultimately, Brandon.
I wouldn't put it quite like that. I think if it's not done in the froth of the cycle, if it's done with grown-up management teams and it's done with an eye on things sometimes other than just the bottom line and synergy, it's corporate culture and all these vague things as well. Those tend to be the deals that are and of course done with very good lawyers. Those tend to be the deals that last, that work well, and that are bedded down.
Brandon Irsigler, we must leave it there. Thank you very much. Director at Norton Rose Fulbright and Vestact, Sasha Naryshkine. Thank you very much for coming in. Thank you also for watching. There'll be more tonight, tomorrow. Till then, bye-bye.